Everyone, it's Paul Tilley, and welcome back to our discussion of macroeconomics. Today we're looking at the last unit, Unit 10, Exchange Rates and Balance of Payments. This unit, you will notice, is covered in Unit 10 of the course and Chapter 11 of the textbook. In this unit, we're going to look at exchange rates and balance of payments. So we're going to calculate the value of the Canadian dollar in terms of other currencies and explain the purchasing power parity theory. We're going to identify who wants to buy and sell Canadian dollars in foreign exchange markets. We're going to explain why the value of the Canadian dollar fluctuates. We're going to compare flexible and fixed exchange rates. And we're going to explain the meaning of balance of payments, surplus, and deficit. First, let's look at exchange rates. Exchange rates are really the rate at which one currency is exchanged for another. So it's the relative value of currencies. So to convert currencies from one to another, you simply take the reciprocal. So for example, if $1 US equals $1.25 Canadian, then $1 Canadian is 1 over 125, or 0.80 United States. We've dealt with that in the first finance course in the first year. In terms of exchange rates, and what we have in Canada is a constant flow of exchange rates. You'll notice that the exchange rates in Canada are considered to be floating, meaning that they adjust from one day relative to the next. And if you look online, you can clearly see what the value of the Canadian dollar is right now relative to any other currency. So currency appreciation occurs when there's a rise in the exchange rate of one currency relative to another. So for example, the Canadian dollar is worth more relative to the United States dollar. Currency depreciation occurs when there's a fall in the exchange rate of one currency relative to another, so it's when the Canadian dollar goes down. And the ultimate question that you would ask is, why does that happen? We're going to look at that in the coming slides. We'll just give an example first. Assume that the Swedish krona is worth 20 cents Canadian. How much is the Canadian dollar worth in krona? So if we took 1 over 20, we can find that the Canadian dollar is worth 5 Swedish krona. If we assume that $1 equals 70 Japanese yen, we'd ask how much is yen worth relative to Canadian dollar. So we take 1 over 70 and we get 1.4 cents. So all this goes to a basic theory called the purchasing power parity theory. Purchasing power theory really suggests that exchange rates will change so as to equate the purchasing power of each currency. In other words, how much that currency can buy of something from someone else. What we have then is a situation where this is happening all the time with floating exchange rates. One currency relative to the other is always being adjusted because of the relative purchasing power of the given currencies. In fact, people can make money on this through something they call arbitrage, which involves purchasing a commodity in a market where the price is low and then selling it somewhere else where the price is higher, so you make your money on the difference. So let's say, for example, coal. Sweden is 1,000 krona a ton and $200 a ton in Canada. So, we've got, you're buying it in Sweden, you're buying it in Canada. So if we look at the implied exchange rate, then it's 1 to 5. We talked about that a slide ago. So 1 krona equals 20 cents Canadian. So if the price of coal in Canada increases $250, everybody would buy coal in Sweden. And the demand for the krona would increase because everybody's racing to buy the cheaper coal somewhere else in the world. So the krona would appreciate until the difference in the price disappears. So naturally it will work its way out of the system. In other words, the deals will be fleeting. So the better deal that you get in one country or another will eventually wash out as money flows to the low-priced area, and that effectively caused the exchange rates to adjust, which brings it back into an equilibrium. Let's look at purchasing power theory a little bit more. So we talked about this purchasing power that's different between one currency and another and how money flows to the low-cost zone, and this causes it to adjust so that the currencies basically have exactly the same purchasing power over time. But it doesn't necessarily work quickly, and this is where arbitrage comes in to be able to spot these gaps and to take advantage of them. Why does it take a long time? Well, many services, such as haircuts, are not traded internationally, so some things are not really affecting the trade value. We got the fact that things need to be transported, or that there's insurance costs in the transport. That affects the value of of the investment. Is it worthwhile buying coal in Sweden, for example? If the existence of tariffs or other trade restrictions, maybe there's limitations in your ability to import coal into Canada. Say, for example, if there's environmental issues, or the expression of particular preferences by the customers. Maybe you want a low soot coal versus a high soot coal that they would produce in Sweden. Maybe we need a better quality coal, and the lower price coal just won't cut it. Or we could think of the effects of the value of currencies, or we could think of the effect on the value of currencies of trade in financial assets. And that's effectively what it comes down to, is that these currencies are always adjusting. We need to think that purchasing power will eventually work towards parity, and the adjustment may take place more quickly than what people would suspect. Next, let's take a look at this issue of how the exchange rates move. What we think about really is that money is a commodity. People buy it and sell it. And because of that, like every other commodity, the laws of supply and demand affect it. So foreigners who want to buy Canadian exports or who travel in Canada are going to increase a demand for Canadian dollars. You're going to need Canadian dollars in order to buy those products from Canada. So foreigners who want to purchase Canadian investments are also going to want Canadian dollars. Canadians who receive income or gifts or transfers from abroad are probably going to want it in Canadian dollars. Currency speculators are going to want Canadian dollars because for the purposes of potentially making some money on arbitrage. So the basic laws of supply and demand hold. The higher the demand for a given currency, the higher the relative price. The demand curve that we saw for every other commodity also applies to the Canadian dollar. So when the Canadian dollar depreciates, then effectively the prices of Canadian exports decrease because people from outside can use their money, convert it to Canadian dollars, get more Canadian dollars for it, and buy more product. So with low value dollar, such as 70 cents relative to US, for example. So lower Canadian dollars encourages exports out of Canada. And when Canadian dollar appreciates, what happens is the reverse. Really, this effectively rises the price of Canadian products for foreigners, and they're probably not going to buy as much. So we're going to see exports decrease. So let's take a look at that from a application perspective. Let's look at the impact of the Canadian dollar under various scenarios. First of all, let's assume Canadian exports rise. So we got more product going out of Canada. That's going to mean that demand for Canadian dollars to buy those products is going to go up. That's going to cause the dollar to appreciate. Vancouver hosts the Winter Olympics. Again, we've got a lot of tourists coming to Canada to watch the Olympics, a lot of participants, a lot of media, a lot of interest in Canada. Thousands of people flock in. They're going to look for Canadian dollars. They're going to want to buy Canadian dollars to be able to spend it here. And that's going to drive up the demand for Canadian dollars, which is going to cause the value of the dollar to appreciate or go up. IBM and the provincial governments announced the construction of a $2 billion data processing complex in Halifax. Again, IBM is going to invest money in Canada. That means they're going to need Canadian dollars. They're going to buy Canadian dollars, going to drive up the value of the Canadian dollar. If we've got migration from the maritime provinces to Ontario, what we're doing is moving from one part of Canada to another part of Canada. It's not going to have any impact on the dollar because the fact is that it's just money trading within the Canadian household. If we look at the supply of Canadian dollars, again, very similar to Canadian dollar, is just a commodity that people buy. To purchase goods from abroad, Canadians buy foreign currency. So if you want to go to a trip to the United States, you're going to have to go buy American dollars, And so that means you're going to take your Canadian, trade it for American. It's going to drive up the demand for American dollars. Increasing the supply of Canadian dollars in the international money market will mean more dollars out there, and that will effectively drive down the value of the Canadian dollar. So when the dollar appreciates, the effective prices of Canadian imports decrease. In other words, it's less expensive to go on a vacation. It's less expensive to buy something from the United States. And what we're going to see is more imports. And you think about it, we know this intuitively all the time. It's expensive to go to Florida now when the dollar is worth about 70 cents American. You got to spend way over $1. You're thinking about $1.30 Canadian for every dollar American. It costs a lot of money. If the Canadian dollar went up, let's say, for example, it went up to $1 for $1, it was an even. It would be less expensive to go to the States relatively because that dollar would buy $1 worth of stuff in the United States. So what drives the supply of Canadian dollars? Well, Canadians who want to buy foreign imports or travel to foreign countries are going to want to buy foreign currencies, and that's going to increase the supply of Canadian dollars on the market. Canadians want to purchase foreign investments, again, increasing the supply of Canadian dollars on the market. Foreigners will receive income and gifts and transfers from Canada, increasing the amount of Canadian dollars on the market. Currency speculators, again, who work on this issue of arbitrage, which is buy it for low, sell it for high. So same sort of thing. We have there the basic supply curve, and you will see that as the quantity of Canadian dollars go up, the price of Canadian dollars in foreign currencies go up. So this little chart here does a good summary of what happens to the Canadian dollar under various scenarios. Equilibrium in foreign exchange is when the supply and demand curves interact, no different than what we've seen previous. And you can see that you'll get an equilibrium point. So demand comes from foreigners, exports, supply comes from Canadians. At equilibrium, the exchange rate, which is the quantity demanded in Canadian dollars, will equal the quantity supplied. So what would happen to Canadian imports if the dollar appreciates? Well, let's think about it. The higher value dollar means that we can buy more product for effectively less money. In other words, it's like saying, okay, the dollar goes up in value relative to the U.S. That means we can buy more U.S. product for a given amount of money. That's going to increase imports. And, relatively, the foreign products will be cheaper. What would happen to Canadian exports if the dollar appreciates? Well, it's going to make Canadian goods more expensive, effectively, so our exports would fall as Canadian products become relatively more expensive to foreign buyers. So now let's look at learning objective 3, changes in demand and supply. So the demand for Canadian currency is really determined by a bunch of factors. The key ones being the level of foreign incomes, how much money people have to spend, the price of Canadian products, how much it costs to buy those things, the relative price of foreign products. We live in a competitive world. If you can buy it somewhere else more cheaply, that's where people are going to buy it. Foreigners' tastes, what people prefer. Is there an appetite for a Canadian product, for example? And comparative interest rates. How much does it cost to borrow money somewhere else versus here? Decreases in Canadian exports would serve to really depreciate value of the Canadian dollar. People aren't buying as much. Demand for the Canadian dollar would go down. This would effectively depreciate the value. It would also decrease the level of aggregate demand and decrease the level of gross domestic product. We wouldn't be making as much in Canada. It would also serve to decrease the price level. Prices would go down because demand goes down. Next, let's look at learning objective 4, fixed versus floating exchange rates. Now, exchange rates have been a topic of discussion in macroeconomics for years. The decision of whether or not to allow a country's exchange rate to vary based on commodity markets has been one that has been debated quite a bit. The debate has largely favored floating exchange rates. Floating exchange rates, just like every other commodity out there in the world, allows the value to float based on supply and demand. Now, there are arguments in favor of both, and there are also arguments against both. We're going to look at some of these. First of all, let's look at the fixed exchange rate, okay? The fixed exchange rate, by definition, the rate is pegged by the government. The federal government in Canada, for example, would peg the exchange rate at X versus Y. Our dollar is worth the amount of another dollar. $1 US, $1 Canadian, for example. And that means that it would not rise and fall, and that would certainly provide a good bit of security, wouldn't it? It adds certainty to international trade. You know exactly how much something is going to cost relative to your own currency. It also prevents instability. Imports and exports would be moderated, or the ups and downs of imports and exports would be moderated, because everybody would know what it's going to cost. It would also discourage this arbitrage currency speculation that we've talked about so far. And it would appeal to people who equate the exchange rate with national prestige. It would sure feel a lot better if the Canadian dollar was worth more. And if we arbitrarily set it more, it would be worth more. You can see the way that fixed exchange rates would lay out versus the law of supply and demand. An increase in demand does not lead to currency appreciation in the case of fixed exchange rates, but the result would be a shortage of Canadian dollars on the world market, or a surplus of Canadian dollars on the world market, depending on supply and demand, where it fell. And the Canadian dollar could effectively be undervalued. We could set it too low. That's a bit of a problem. Now, flexible exchange rates, on the other hand, they are determined by the market forces of supply and demand and are not interfered with by government. So it's hands off. Really, this is an idealistic perspective that the law of supply and demand affects our current our exchange rate. Really, most governments have some sort of a managed exchange rate where government can get involved or can activate some of its macroeconomic levers to cause the exchange rate to go higher or lower. And managed exchange rate, or what's called a dirty float, occurs when there's a certain degree of management by the central bank of the exchange rate, such as the case in Canada. Most economists really favor the flexible exchange rate system. Well, why? Because really it avoids the unnecessary adjustments for inflation and things like that. And it results in a fixed... It also avoids the necessary adjustments for recessions. As a result, fixed exchange rates would have the currency overvalued, and that could cause all kinds of problems with regards to exports and imports. It also doesn't require a country to fix its exchange rate to that of another country and thus relinquish an independent monetary policy, as in the case with the fixed exchange rate. Finally, Learning Objective 5 deals with balance of payments. What exactly is a balance of payment? Well, a balance of payment is the accounting of a country's international transactions that involves the payment and receipt from foreign countries. We have what's called a current account, which is a subcategory of the balance of payments that shows the income and expenditures related to exports and imports in a given year. A country's capital account is a subcategory of the balance of payments that reflects the changes in ownership of assets associated with foreign investments. And a country's official statements of account is a subcategory of balance of payments that shows the change in a country's official foreign exchange reserves. Finally, we'll look at Learning Objective 5, which looks at the balance of payments. And what we're gunning for here is to get an understanding of what exactly is balance of payments. Well, balance of payment is an accounting of a country's international transactions that involves the payment and receipt of foreign currencies. We have what's called, within that, we have what's called a number of subcategories, okay? First of all, we got what's called the current account, which is a subcategory of the balance of the payments that shows the income and expenditures related to exports and imports in a given year. We also have something called the country's capital account, which is a subcategory of the balance of payments that reflects changes in ownership of assets associated with foreign investment. And we also have another subcategory called the official statements account, which is a subcategory of the balance of payments that shows change in the country's official foreign exchange reserves. A country's balance of trade is a value of a country's export of goods and services less the value of its imports. So it's basically the same as net exports that we've talked about earlier in the course. A country's foreign factor income is the income in form of wages, interest, and dividends, basically the land, labor, and capital, that nationals receive for providing the services to another country. And you can see here that this is the 2019 figures for Canada that illustrate those various subcategories. That's a quick summary of what we looked at in this unit. If you have any questions, let me know. Thanks for listening.